At the core of every successful multinational company lies a well-oiled machine known as the Treasury function. This crucial department is the backbone of financial operations, ensuring that every financial decision aligns with the company's strategic goals. Like the heart-pumping blood to vital organs, the Treasury ensures the smooth flow of money throughout the organization. It manages the lifeblood of the company, making sure that funds are available where and when they are needed. Its role is paramount in managing the financial health and stability of the company, especially when operating across multiple countries. The Treasury must constantly monitor and adjust to the financial landscape, ensuring that the company remains solvent and profitable. The Treasury team is responsible for a wide range of critical tasks, from managing cash flow and investments to mitigating financial risks. They must forecast future financial needs, plan for contingencies, and make strategic decisions that will benefit the company in the long run. The Treasury function plays a pivotal role in multinational companies. It acts as the central hub for all financial activities, coordinating between different departments and ensuring that everyone is working towards the same financial objectives. These companies face a unique set of financial challenges due to their global reach. Fluctuating exchange rates, varying interest rates, and diverse regulatory environments are just a few of the complexities that treasurers must navigate. They must also stay informed about global economic trends and geopolitical events that could impact the company's financial standing. Treasurers must be adept at managing these variables, using their expertise to make informed decisions that will protect and grow the company's financial assets. They must also ensure compliance with all relevant regulations, which can vary significantly from one country to another. Their decisions have a direct impact on the company's profitability and overall success. By effectively managing the company's financial resources, the Treasury team helps to secure a stable and prosperous future for the organization. Before delving into the specifics of Treasury operations, it's crucial to understand the overarching financial objectives that drive these activities. Multinational companies, like any business, aim to maximize shareholder value. This means making strategic financial decisions that enhance profitability, ensure long-term sustainability, and generate attractive returns for investors. Capital allocation is a key aspect of this process. It involves carefully choosing where to invest the company's resources for the best possible outcomes. Should the company invest in new projects, expand into new markets, or return profits to shareholders through dividends or share buybacks? The Treasury function plays a crucial role in evaluating these options and making recommendations based on thorough financial analysis.
One of the most fundamental responsibilities of the Treasury function is liquidity management. This critical task ensures that a company can meet its financial obligations at all times, maintaining smooth operations and financial stability. Simply put, this means ensuring that the company has enough cash on hand to meet its short-term financial obligations. These obligations can range from paying suppliers for goods and services to covering employee salaries and other essential operating expenses. This includes paying suppliers, salaries, and other operating expenses. Without effective liquidity management, a company could face severe disruptions, potentially jeopardizing its entire operation. Effective liquidity management is crucial for the day-to-day operations of any business, but it becomes even more complex in a multinational context. Companies operating across borders must navigate different financial regulations, currency fluctuations, and varying economic conditions. Treasurers must carefully monitor cash flows across different subsidiaries, currencies, and time zones. This requires sophisticated financial tools and constant vigilance to ensure that funds are available where and when they are needed. They need to optimize working capital by managing accounts receivable, money owed to the company, and accounts payable, money the company owes to others. Effective management of these accounts helps maintain a healthy cash flow, which is vital for sustaining business operations. Efficient money transmission systems are essential for moving funds quickly and securely between different parts of the organization. These systems help in reducing delays and minimizing the risk of financial shortfalls. Additionally, Treasurers may invest excess cash in short-term, low-risk instruments to earn a return while maintaining easy access to funds when needed. This strategic approach not only maximizes the utility of available cash, but also ensures that the company remains financially agile and prepared for any unforeseen expenses.
While liquidity management focuses on the short term, funding management takes a longer-term perspective. It involves securing the necessary funds to finance the company's growth and expansion plans. This could include investments in new equipment, research and development, acquisitions, or expansion into new markets. Multinational companies have a variety of funding sources at their disposal. They can borrow from banks or other financial institutions through loans or by issuing bonds in the capital markets. They may also explore alternative sources of funding, such as private equity or venture capital. The Treasury function plays a key role in developing and implementing funding policies that align with the company's overall financial strategy and risk tolerance.
Section 5. Mastering the currency maze, managing exchange rate risks. Operating in multiple countries exposes multinational companies to currency risk. Exchange rates fluctuate constantly, and these fluctuations can significantly impact a company's profitability. For example, if a company earns revenue in a foreign currency that weakens against its home currency, its profits will be reduced when converted back. The Treasury function is responsible for managing this risk. They develop and implement currency exposure policies to mitigate the potential negative impact of exchange rate movements. This might involve hedging strategies, such as using forward contracts or options to lock in exchange rates for future transactions.
Section 6. Derivatives, tools for shielding against uncertainty. In this section, we will explore how derivatives can be powerful tools for managing financial risks and uncertainties in the ever-changing global market. Derivatives are financial instruments that derive their value from an underlying asset, such as a stock, bond, currency, or commodity. These instruments can take various forms, including options, futures, forwards, and swaps, each serving different purposes and strategies. They are widely used by multinational companies to manage various financial risks, including currency and interest rate risk. By using derivatives, companies can protect themselves against unfavorable market movements that could impact their financial performance. One common use of derivatives is in hedging, which involves taking a position in a derivative contract that offsets the potential loss from an adverse movement in the underlying asset. This strategy is essential for companies looking to stabilize their cash flows and ensure predictable financial outcomes. For example, a company that is due to receive a payment in a foreign currency in the future could use a forward contract to lock in the exchange rate today, thereby eliminating the uncertainty of future exchange rate fluctuations. This not only provides peace of mind, but also allows for more accurate financial planning and budgeting. By effectively using derivatives, companies can navigate the complexities of the financial markets with greater confidence and security. Section 7. Taming interest rate volatility, derivatives in action. Interest rate risk arises from the possibility that interest rates may move unfavorably. For example, a company that has borrowed money at a variable interest rate faces the risk that interest rates could rise, increasing its borrowing costs. Derivatives can be used to manage this risk as well. Interest rate swaps, for instance, allow companies to exchange their variable interest rate payments for fixed interest rate payments, providing greater certainty over future cash flows. Other interest rate derivatives, such as interest rate futures and options, can be used to hedge against specific interest rate movements or to speculate on the direction of interest rates.
Section 8. The strategic role of corporate finance. Beyond managing day-to-day financial operations and mitigating risks, the Treasury function often plays a key role in strategic corporate finance activities. This includes decisions related to the company's capital structure, the mix of debt and equity used to finance its operations, mergers and acquisitions, and project finance. The Treasury team's expertise in financial modeling, risk assessment, and capital markets is invaluable in evaluating potential M&A transactions, structuring project financing, and making optimal capital structure decisions.
Section 9, the Treasury function, a cornerstone of success. In conclusion, the Treasury function plays a vital role in the success of multinational companies. From managing day-to-day cash flow to mitigating financial risks and supporting strategic decision-making, the Treasury team is essential for ensuring the financial health and stability of the organization. Effective Treasury management contributes directly to maximizing shareholder value by optimizing financial resources, mitigating risks, and supporting the company's growth and expansion objectives. Section 10, Conclusion: Navigating the Future with Confidence. As the global business environment becomes increasingly complex and interconnected, the role of the Treasury function will only continue to grow in importance. Multinational companies will need to rely on their Treasury teams to navigate the challenges and opportunities of the global marketplace, from managing currency volatility and interest rate risk to securing funding for growth and expansion. By embracing best practices, leveraging technology, and fostering a culture of risk awareness, Treasury functions can continue to be a source of competitive advantage for multinational companies in the years to come.